Jambo, welcome again to Kurgateric Finance and Accountancy Tutorials. Today, we are going to look at the accounting books, or what we refer to the books of accounts. But before we continue, if you are new to this channel, consider subscribing to the same. Make sure also you ring the notification bell so that whenever I upload a new video, you'll be the first one to get it right on your device. Also, like and you share. Share with as many friends as possible so that we can all get to benefit from this video. Also, I request you to do a comment on the comment section. If you feel that you have a question that you've not understood anything from this video, kindly feel free to post it on the comment section. I will get it and I will respond as appropriate. So without much ado, let's move on to our today's session, which involves accounting books. So from the term accounting books, these are the books where transactions of the business organizations are recorded. And these accounting books are broadly classified into two. We have the subsidiary books, and the principal books. So these are the two broad classifications of accounting books. The subsidiary books are whereby transactions are first recorded in the organization. When the transaction occurs, this is whereby that transaction is first recorded. These subsidiary books can also be referred to as the books of original entry. They can also be referred to as the books of prime entry, and they can also be referred to as the day books, and also they can be referred to as the journals. These terms here, the books of original entry, the books of prime entry, the day books, and the journals, means one and the same thing as the subsidiary books, because this is whereby the transactions of the business organizations are first recorded. They are referred to as the day books because this is whereby the daily transactions of the organizations are recorded. And they are referred to as the journals because this is whereby transactions are recorded chronologically in the order of their occurrence. The principal books, on the other hand, follows the double entry system of accounting. Take note, the subsidiary books do not follow the double entry process of accounting, but the principal books do. So let's move on to looking the various types or categories of subsidiary books and also the principal books. I can do a table like that so that to show the various types of subsidiary books and the two types of the principal books. The subsidiary books are as follows. The first one, the sales day book, or what we refer as the sales journal. Number two, the purchases day book, or what we refer as the purchases journal. Number three, we have the returns on the two, the sales returns journal. Number four, the returns on purchases. We refer it as purchases returns journal. Then you have the fifth journal, or the fifth subsidiary book. We refer it as the general journal. Then the last one is the cash book. So these are the subsidiary books, or the books of original entry. In a business organization, there are two transactions that mainly happen, or those activities that mainly happen in an organization, and those are sales and purchases. We either sell to our customers or we purchase from the suppliers. So the sales journal, whereby the sales are first recorded. Purchases is whereby the purchases are first recorded. The sales returns is whereby if our customer on this side, whom we had sold goods to, decides to return them, either because they were damaged or they were in excess. So we are going to record those returns on the sales returns journal. This sales returns journal can also be called the return inwards journal. And why are we calling it return inwards? It is because since we had sold out to the customers and then they decide to bring in, or rather to return, they are returning inside the business. So that is why they are called the return inwards journal. The purchase returns journal also is the return on purchases. This purchase returns journal can also be called the return outwards journal. We had purchased into the organization, but we are now returning some, returning out of the organization. So that's why they are known as return outwards journal, another name of purchase returns journal. Then you have the general journal and the cash book. So the principal books are normally categorized into two. We have the ledgers and we have the cash book. I know many of you, or rather I know you're asking yourself this question: why is the cash book appearing in both sides, that is as a subsidiary book and at the same time as the principal book? As I had told you earlier, the subsidiary books do not, I want you to take note there, do not follow the double entry rule of accounting, but the principal books do follow the double entry system of accounting. So that's why you'll find the cash book here and the cash book as a principal book. Take note, cash book is the only book of original entry that follows the double entry rule of accounting. The subsidiary books are sales journal, number 2, the purchases journal, and then the return on the 2, you have the sales returns, journal, purchases returns journal, and then number 5, the general journal. This general journal can also be called the journal proper. Journal proper. Then the last one is the cash book. So I want to define the sales journal, each and every journal here, including the cash book, and then we look at their source documents. The sales journal, this is a book of original entry, whereby credit sales are first recorded. Credit sales only are recorded in the sales journal for the first time. And then the purchase journal, on the other hand, records credit purchases. Records credit purchases. The sales returns journal, on the other hand, records the returns on sales. And then the purchases returns journal records returns on purchases. This one records return on purchases. And then you have the general journal. General journal records any other transaction that does not find its way either on the sales, purchases, or sales returns, purchase returns, or the cash book. And then the cash book records all the cash transactions, all the cash transactions. I want you to take note here. The sales journal records credit sales only, not cash sales. Anything cash will be recorded in the cash book, but the sales journal records credit sales. The purchase journal records the credit the credit purchases, not the cash purchases. And then the sales returns journal records the returns on the credit sales. And then the purchases returns journal records the returns on the credit purchases. And then the general journal records any other transaction that do not find its way in the other 5 journals and the cash book. The cash book on the other side records all the cash transactions in the organization. These books record the credit part, but the cash book records the cash transactions in the organization. We check on the source documents. The source documents of each and every subsidiary book here. The sales journal. Since you are selling goods to another person on credit, that person becomes our customer. And that customer, in business language, you call him or her a debtor. So when you sell goods to that debtor or to that customer, the document that we are going to attach to show evidence that we have sold goods to him or her on credit is referred to as an invoice, and a sales invoice. Sales invoice. Purchases journal. When we purchase goods or services from a supplier outside there, we become their customers, but from our side, we call them the creditors. They become our creditors. The source document to show that we have received goods from the supplier. The supplier is going to issue us with what is known as the purchase invoice. Purchase invoice. And then for the sales returns journal, I told you that the sales returns journal records the return on credit sales. And I told you that when we sell goods to somebody on credit, that person becomes a debtor. And then this person has decided to return some goods, either because they were damaged or excess. So that person is going to attach, when returning those goods to the business organization, they are going to attach what is known as a credit note. A credit note. So let me explain what a credit note is, why we refer it as a credit note. Remember, I told you that when we sell goods or services to a person, that person becomes a debtor. And debtors have got debit balances. So when we sell to a person on credit, we are going to record in his account, the debtor's account, that the debit side of the debtor's account has increased by a certain amount of goods that we've sold to him. But when he decides to return the same and attach the credit note, means that it is telling the company to reduce his account by a certain amount of goods that he or she has returned. So in that case, he is going to attach a credit note to tell us that in my account, kindly credit this amount of goods or services that I have returned. So that's why it's known as a credit note. Then move to our purchases returns journal. The source document here is the debit note. And why debit note? Remember, when we purchase goods from a supplier on credit, we become creditors. And creditors have got credit balances, the creditors. So when you decide to return goods to the supplier, we are going to attach what is known as a debit note. Remember, the creditors normally have credit balances. And then when returning, it means that we are reducing that balance on the credit side. And the reduction of that balance is normally done on the debit side of the creditor's account. So that's why we are debiting. We are attaching this note to tell the supplier that please debit our account with the amount proportionate to the ones that we have returned. So that's why it's known as a debit note as the source document. The general journal, source document for the general journal is the general voucher. the general voucher. And then the cash book. When we sell goods or services to a person in cash, we are going to issue this person with a receipt. We are going to issue him with a receipt to show evidence that we have sold goods to that person in cash. So, ladies and gentlemen, so those are the source documents for these books of original entry. So, ladies and gentlemen, up to this point, we are able to explain what the sales journal is, what the purchase journal is, and the others, what they mean. The sales journal in an examination setting, this is how you are going to put it. Sales journal is a subsidiary book of account that records credit sales. Subsidiary book of account that record credit sales. Purchases journal is a subsidiary book of account that record credit purchases. Sales returns journal is a subsidiary book of account that record return on credit sales. And then is a subsidiary book of account that record the return on purchases. The general journal is a subsidiary book of account that record any other transaction that does not find its way in the special journal. And then the cash book is a subsidiary book of account that record cash transactions. So, ladies and gentlemen, I want also to tell you that the sales journal, the purchases journal, the sales returns, the purchases returns, and the cash book, all these are known as the special journals. Special journals. The general journal is not part of special journals. Why? Because the general journal is not specifically made to record a certain transaction. Remember, we say that the sales journal is a special subsidiary book recording credit sales, specially for credit sales. Purchase journals made specially for credit purchases. The sales returns journal is made specially to record returns on sales. The same case applies to purchase returns journal, which is made specially to record return on purchases. And then the cash book is specially made to record the cash transactions. And then the general journal, as I told you, is not a special journal because it records any other transaction. It doesn't specify any other transaction that doesn't find its way in the special journals. The principal books are divided into two, and these principal books follow the double entry rule of accounting. The books are divided into two. We have the ledgers and we have the cash book. The ledgers and the cash book follow the double entry system of accounting. Ledgers are divided into two. We have the personal ledgers and we have the impersonal ledgers. From the term personal, these are from the term personal ledgers, these ones are accounts, records the accounts of persons. These personal ledgers are further divided into two. The sales ledger and the purchases ledger. The sales ledger records the accounts of debtors. Then the purchase ledger on the other side shows the accounts of creditors. The personal accounts of debtors and the personal accounts of creditors on this other side. Take note, Don't see that because this is a sales ledger, it means that this one contains the accounts of sales. No. This one is personal. We are dealing with personal accounts. So this one, we normally sell goods to our debtors, isn't it, for customers? And customers are referred to debtors in the organization. So when we sell goods or services on credit to them, we are going to record the same in what is known as personal ledger under the sales ledger, but we are not going to say sales. We are going to write the name of that customer. So sales ledger contains the accounts of debtors and not the accounts of sales. The purchases ledger, on the other hand, contains the accounts of creditors but not of purchases. Let's move on to our impersonal ledgers. They are divided broadly again into two. We have the general ledger, or what we refer to as the nominal ledger, and the private ledger. Private ledger records, I don't know if this normally exists in the organization. This is a ledger that records the private issues of the owners of the organization. And accounts that can be found here in a private ledger are accounts like the profit and loss account. You can find the profit and loss account. The accounts of capital account. We have the drawings account. And then you have a second category of principal books, being the cash book. As I told you, a cash book is a subsidiary book of account that records all the cash transactions, and it is the only book of account that follows the double entry rule of accounting. The cash book is divided into a single column cash book. We have the double column, cash book. Then we have the triple column cash book or 3-column cash book. Then finally we have the petty cash book. A single column cash book, this is a cash book that records either cash or bank transactions separately. So we are going to record the accounts for cash separate, and then we open the column for bank and separate account. So let me draw cash account. We'll have an account of cash. An account is a book, an account is a page in a ledger that has got two sides, the debit side and the credit side. So the left hand side is referred to as the debit and right hand side is referred to as the credit. So for the single column cash book, this side is referred to as the debit and this side is referred to as the credit. So that's how you do. Or since it is a single column cash book, and I told you that in a business organization you can have the cash or the bank. So we can also have we'll have the bank account separately. It's a single column. Each of these transactions, the cash transactions, bank transactions, each account is opened separately. Account for cash, account for bank. So that is how the single column cash book looks like. And then we have number 2, double column cash book. From the term double, it means that double means 2, isn't it? So we are going to open just one account that will accommodate the cash and the bank transactions, the bank and the cash entries. So this is how it will look like. If I may draw, I told you an account has got two sides. We have the debit side and the credit side. So in the double column cash book, we'll have the cash and bank, the columns for cash and bank and amount. The other side also, the cash, bank and amount. So that is how the double column cash book will look like. We have the column for cash, column for bank on the debit side, the column for cash, column for bank on the credit side, the 3-column cash book. The 3-column cash book will take this form, this format of the double column cash book, but will have an additional entry of discounts. It is 3-column because you have a column for cash, column for discount allowed on the debit side, column for bank, and then you have the column for cash, column for discount received, and the column for bank on the credit side. So that is the 3-column cash book. Then the last cash book is the petty cash book. This one is not available to all organizations. We have specific organizations that use the petty cash book. The petty cash book is there to cater for petty expenses in the organization. So this one normally applies to these huge organizations. These organizations at times normally have huge inflow and outflow of cash. So to cater for those petty cash expenses, a petty cash book is opened and is normally managed by a petty cashier or a petty accountant. So, and the reason is, if we decide to put each and every, or rather record each and every, these minor expenses or the petty expenses in the main cash book, we might end up inflating the cash book. And the petty cashier is normally given some amount of money, which in accounting we refer it as the interest. The interest. This is the amount that is given to the petty cashier so that to cater for the petty needs of the organization, or the petty needs of the department. And then at the end of the period, the petty cashier is expected to surrender the same so that they can be reimbursed. They can be reimbursed amount equivalent to what they had used or what they had spent. So that is a petty cash book. That is what a petty cash book is. So ladies and gentlemen, today we've learned about the accounting books. And we said the accounting books are normally divided into two: the subsidiary books and the principal books. The subsidiary books, these are the books whereby transactions are first recorded, and they do not follow the double entry system of accounting except the cash book. We say the principal books follows the double entry system of accounting. We went further, listed down the subsidiary books, and we say the first one was sales journal, which records only credit sales. The purchases journal that records only the credit purchases. The sales returns journal, which records only the credit on sales. Purchases journal, which records only the returns on purchases. And then you have the general journal, which records any other transaction that doesn't find its way in the special journals. And then you have the cash book that records all the cash transactions in the organization. We said the sales journal, purchases journal, sales returns journal, purchases returns journal, and the cash book, all these are known as special journals because they are specially made to record special transactions in the organization. We went ahead and we saw the source documents for these books of original entry. We say the source document of the sales journal is an invoice, and an invoice that is known as a sales invoice. Then you said a source document for purchase journal is a purchases invoice. The source document for sales journal is a credit note, and the source document for the purchase returns journal is a debit note. We also said a source document for the general journal is a general voucher. And then we said the source document for the cash book is a receipt. We also moved ahead and looked at the principal books. We say these principal books follows the double entry system of accounting, and they are divided into two, the ledgers and the cash book. We said the ledgers are further divided into the personal ledgers and impersonal ledgers. We said the sales ledger records, or rather contains the accounts of all the debtors in the organization. And then the purchases ledger contains the accounts of creditors in the organization and not the purchases. We also said the impersonal ledgers are divided into two. We have the general ledger, which we also termed it as a nominal ledger, and we also had the private ledger. We said the general ledger contains the accounts, all other accounts that doesn't find its way into the personal ledgers. We also said the private ledgers contains the accounts that they are kept private by the owners of the business organization. And these accounts can be the capital account, the accounts of profits and loss in the company, the accounts of drawings, and those other the accounts that maybe the owners of the organization doesn't want to expose to other people. We also moved ahead and saw another category of the principal books, which is the cash book. So we also said a cash book is divided into the single column cash book, the double column cash book, 3-column cash book, and the petty cash book. So ladies and gentlemen, that marks the end of our session today. Until next time, it's goodbye for now. Thank you. So these